So hello everybody. I am looking at slides from chapter 4, and I kind of jumped ahead a little bit to, I believe it's slide 5. And what I want to talk about here is the concept of depreciation. And basically what it is if you buy something at a fixed cost, you start to lower its value because it's losing value over time, right? And you're charging against annual revenues. So there's a method used called MACRS, which MACRS stands for Modified Accelerated Cost Recovery System, and it's just one of many methods, mostly used for tax purposes, to calculate your depreciation. And you basically write off, fixed assets. And as I said, there are many other methods that are used, but the most popular is MACRS here. So I just want to make that point. There's a couple slides here. So let's look at this example right here. So Baker Corporation buys a new machine, and it's going to cost $38,000, and it's going to cost $2,000 to have someone put it in. So basically, when the machine is old and beat up, they expect it's going to sell for scrap metal. They're going to salvage it right here for $1,000. And the important point is, what's the depreciable value of the machine? And the depreciable value is only, make sure we're clear about this, the purchased cost plus the installation cost, $40,000. You'll notice that the expected salvage value is not included, okay? So just please to make a point, again, do not include that scrap metal salvage value. It's $38,000 plus $2,000, it's $40,000. So now we start to depreciate it. So you'll notice what it says here, no adjustments are required for expected salvage value. We're going to look at some of the tables now for depreciation. And here is the property class, and you'll notice this is an old table, but the IRS will provide an updated property class telling you how many years you can depreciate something. So for instance, look at 5 years here. Computers, printers, copiers, and 10 years they've got equipment used in petroleum refining. And 7 years is office furniture and the like, right? So you can look through this table, and you'll get some good information about it. Now, here is the percentage by recovery year that you would write off. So for the 3, 5, 7, and 10 year that we just looked at, the first year you depreciate by 20% for 5 years, then 32%, then 19, then 12, then 12, then 5. You notice how this always adds up to 100 in either case. So you have a higher acceleration up front, right? Which is why they call it acceleration, right? You're depreciating the money up front faster, right? Okay, so I want to make sure everybody's clear about that. So here's an example. Here's the $40,000 machine that we purchased, including the installation, right? $40,000, and they tell you it's a 5-year recovery. And you'll notice here, here's the cost. The first year is 20%, as in the table we saw. Then 32, then 19, then 12, then 12, then 5. So as you can see, if I multiply these, I depreciate it. And when I'm done depreciating, its book value has been fully depreciated, and it's got a book value of 0. Okay? So after year 1, you'll notice we depreciated $8,000. So that means it has a book value of how much? $32,000, right? And it keeps depreciating towards 0. See, now notice how it's fully depreciated here. And that's an important concept, right? Companies do that so they can write down their value. All right, so when we talked previously, and this is kind of like a review, the statement of cash flows had 3 sections. Remember that? Here's the operating flows, and here's the investment flows, and here is the finance flows. And these are the 3 sections of a statement of cash flows. So I just wanted to make that clear. And we've seen that already in chapter 3. Okay, so what I have is inflows and outflows of cash, and here's the inflows on the left, and here's the outflows on the right of this line here. And you'll notice that if a decrease in any asset is an inflow, right? Because I bring cash in. An increase in any liability means I write more bonds or debt, so I bring more cash in. My net profit on my bottom line of my income statement, money comes in. And depreciation helps me bring money in, even though it's a non-cash charge. And if I sell stock in some other company, right, or even in my own company, but a lot of times that's an increase in a liability. And everything is opposite that of outflow. I have to, if I buy an asset, right, I have to spend cash on it, so that's an outflow of cash. And if I pay dividends on my stock, I need to spend my cash. So all these are opposite pretty much of what you see on the inflows. If you have any questions on that, you can email me. And I just want to show you, here's the income statement, all right? And here is the depreciation expense, right, that we talked about, right? And that's part of our total expenses, right? And you'll notice that we basically, here's our total expenses. We write that off of the $700,000, and we end up with our EBIT. Okay, so you're lowering your taxes. You notice we're going to have lower taxes here. All right, so, and here's a balance sheet. Notice on the balance sheet we have the accumulated depreciation. Right here, look, accumulated depreciation is the depreciation not for just 1 year, but for all the years we've been accumulating it. So you just keep adding it up, and this is our total depreciation. I hope everyone's clear about that, and if you're not, just get back to me. Here's the liability side of the balance sheet. And again, here's the cash flow statement. And again, there's 3 components: operating and cash flow from investment. And here is cash flow from financing. Okay, so that gives us our total cash flow when we add those 3 sections up. All right, I'm kind of going to skip you're not responsible for this slide here, slide 18. I'm not going to worry too much about that, and we're not going to worry too much about up through slides 20 or 21. What we're going to start worrying about is financial planning, okay? So let's look at the financial planning process here. All right, I'm going to shoot ahead a little bit here. A lot of these slides you can go over yourself rather quickly. And this is the most important thing now. We're going to talk about a cash flow or a cash budget forecast statement right here. Okay, and that's important. So we're going to worry about that. And all right, so I'm going to jump ahead. This is very, very important. You should know how to do this slide. This is the general format of the cash budget. Okay? And again, I'm going to stop after about 15 minutes because they get too long. But here's my total cash receipts. That's the money I bring in, everybody, right? Receipts. Here's what I pay out in disbursements. I subtract that, and I get my net cash flow. Now, if I have any beginning cash before I started bringing in my receipts, I put that there, right? And I end up with my ending cash. Now, sometimes you want to keep some minimum cash balance, so you keep that, let's say, in your checking account. So you subtract that off, and you either have to know how much you have to finance or how much excess cash balance you have. Okay, so this is important, and we're going to have a spreadsheet for the receipts and for the disbursements, a separate spreadsheet, and we'll look at that now. And here is all the documentation you will need, okay, for the budgeting. Read this carefully, and if you have any questions, please email me. Okay, so here is the cash receipts, right? And basically, we look here, and we have the schedule of projected cash receipts. you will notice here's the sales coming in, right? Here's the sales, and here's our sales forecast. Notice this is cash sales, which is 10% of the forecast, and here's the collections of accounts receivable. They're lagged 1 month, and they're lagged 2 months. If you don't understand that, email me. And here's our total cash receipts. So once we have this table, we can go back and we can fill in. Let me go back. So these numbers right here will fill in right up here. Total cash receipts. Okay? So we'll know that. All right, now the disbursements. Now we've got disbursements, and this table will tell us all about our disbursements, which we'll fill in on that first table. So here's our purchases, right? And here's payments of accounts payable. And here's our rent, our wages and salaries, our tax payments. And this is all these items are going to give us our total cash disbursements. All right? So, all right. So anyway, here's our total cash receipts. So here's our full here's our receipts, and here's our other statement from our cash disbursements, and then we just start subtracting off our. We subtract here, and then we add our beginning cash, and we have our ending cash. And you should go through this slide very carefully. Here we have our excess cash balance. We had extra money, and here we had money we were short, so we had to finance. Okay, so everyone should be aware of that. Any questions, email me. Okay, so here's the bottom line when we're all done. Here's our marketable securities, our cash, and our notes payable. And here's a personal finance example of that. Okay, so you'll notice here this table gets a little more cumbersome, but what they're doing is we did the most likely before, right? We just finished doing that here. And then they say, well, what about if we have a pessimistic and an optimistic viewpoint? Okay, so here would be our pessimistic, and we just do the whole process all over again with the numbers that they gave us, right? So there's 3 scenarios here. Okay, so it's really all the same. So, go over that. All right. So I'll create another video in a bit. I'm going to stop here, and I'll create another video in a bit and go over pro forma income statements. I'll pick up on this slide here, which is slide 44. Alrighty, I'll talk to everybody later. Again, any questions, email me.